We're diving immediately into an analysis report submitted to us. Robinhood just woke up, plus 3.5% surge, and what comes next?
Right. It's detailing Hood's technical breakout past 121, projecting some really aggressive targets, up to $180, based on catalysts like prediction markets and its new AI.
And the material is extremely timely. It makes a very strong case for future growth by pulling in these highly current, very specific market catalysts.
It really does. You've got the supercycle idea for prediction markets, the new Robinhood Cortex AI assistant for gold members, and then you have Cathie Wood's ARK Invest buying in.
That's a powerful narrative.
Absolutely. The report succeeds in establishing the immediate what. Hood closed strong, it's holding support, and the immediate why with those three drivers. The price levels are clear and actionable.
I agree. But our job here is to help transform this from a high-energy market assessment into a really robust analysis that can confidently justify those big targets, $155, $180, to a very discerning professional investor.
Exactly. We want to sharpen the editorial lens and just make sure the framework is as strong as the conviction. So let's move straight into where we see the biggest opportunity.
Okay.
Our first major observation really centers on aligning the tone with the analytical depth.
Right. I mean, the sophistication of the metrics you're discussing here, you're talking about justifying a $109 billion market cap, a PE of 50. The overall tone and style needs to match that level of rigor.
Yeah.
Right now, it feels more like an exciting market broadcast. We need to shift it toward a professional investment report.
And the weakness, to put it simply, is that the current language leans a bit too heavily on hyperbolic rhetoric.
You mean phrases like, woke up angry?
That's, and one-way ticket to the moon, this beast is just getting started. Look, it definitely generates excitement about the breakout. I get that.
Sure, it creates energy.
But when you're making a fundamental case for a premium valuation, like a PE of 50, that kind of intensity can actually make the analysis feel more speculative than grounded. It undermines the credibility you're trying to build.
If the core argument is that this stock deserves a 50 times forward PE, the language has to reflect a meticulous, almost clinical level of confidence. You have to remove anything that suggests hype over homework. So the suggestion is pretty straightforward. Replace those sensational metaphors with precise, conviction-based terminology, the kind you'd see in professional financial reporting. The language should reflect the rigorous process that led you to those $155 and $180 targets. You've clearly done the work. Now the report just has to sound like it.
Exactly.
So can you offer a few concrete examples? How do you make that shift without losing the core conviction?
Absolutely. Let's take the technical breakout. So instead of saying the stock smashed through resistance,
Which is very evocative.
it is, but you could describe it as a volume-driven technical break above the psychological $120 level, confirming a structural shift in market momentum. It conveys the same urgency, but it uses terminology that a sophisticated reader expects.
That immediately anchors the event in quantifiable metrics, not just emotional reaction.
And then look at the closing statement. Instead of the high energy, do not sleep on HOW, you can reframe that conviction around the technical levels you already established in the report.
Okay, so what would that sound like?
As long as the stock maintains decisive support above the $118 technical floor, the path of least resistance remains aligned with current analyst targets. It shows powerful conviction, but it respects the technical boundaries you identified.
That's sharp. And that really leads us to our second major area for improvement. We need to talk about integrating counter-arguments and risk management.
Yes, this is crucial. When you present a growth thesis this compelling, especially one driven by disruptive tech, you absolutely have to show you understand the potential headwinds.
This is where an analysis really proves its quality, isn't it? A purely bullish narrative, it always feels like there's a piece missing.
There is. The report identifies 3 really strong drivers, but it completely ignores the counterarguments or friction points that could challenge those aggressive targets.
If you're asking an investor to accept the kind of volatility that comes with a PE 50 stock, you just can't ignore the potential points of failure. The reader knows those risks exist.
Right, and expecting you to address them. For example, Robinhood Cortex is presented as a major catalyst, but what's the competitive landscape for that tool?
Are other major brokerages rolling out something similar? Maybe something even better that dilutes the advantage?
Exactly. And even more critically, what about regulatory uncertainty? That constantly looms over high-growth fintech, especially something like prediction markets. That whole sector is incredibly sensitive to legislative changes.
And regulatory caps could just crush the revenue potential.
So the solution here isn't to back away from the bullish theses. It's to add a specific, brief section that's dedicated to risk assessment. It shows the conviction is actually tested and resilient.
It demonstrates rigor. It shows the reader you've thought about the variables and decided that the catalysts still outweigh those risks.
That's it. That kind of layered analysis strengthens the conviction, so much more than just omitting the risks.
Okay, so let's make this actionable. When we're looking at that PE of 50, what's the most critical risk associated with keeping that multiple?
Well, you have to contextualize it. A PE of 50 times foreign earnings means the market is pricing in near-perfect execution. There's zero room for error.
Right, so the material risks have to be acknowledged. You could add a bullet point on regulatory risks, something like, is there a risk that focusing solely on the prediction market supercycle might overlook looming legislative challenges that could limit this segment's revenue potential? That doesn't undermine the growth thesis, it just frames the uncertainty. And what about the valuation mechanics? The analysis has to acknowledge how fragile that 50 multiple really is.
Absolutely. You should identify that core vulnerability. Just add a sentence acknowledging that if consensus growth targets are missed, even slightly, that 50x PE ratio is highly vulnerable to rapid multiple compression.
It shows you understand how growth stocks actually behave. Addressing the risk doesn't diminish the opportunity. It just validates your depth of analysis. And that leads us right into our final, and probably most critical critique, quantifying the link between the catalysts and the actual valuation. The logical connection between the new catalysts, prediction markets, Cortex II, and those aggressive price targets of $155 and $180. It needs to be rigorously quantified to justify a PE of 50.
Yeah. The weakness here is that the analysis just sort of asserts that the 50 PE is justified by general growth and new AI and crypto products. It treats that assertion as proof.
But a real financial analysis needs to translate those qualitative catalysts, a new AI tool, into specific quantitative valuation drivers.
Right. Right now, the leap from the $121 breakout to the $180 target feels too wide. It's like the analyst targets are being cited as fact rather than being derived from the new revenue streams you're talking about.
So if the premise for the $180 bull case is, say, margin expansion from Cortex or new revenue from prediction markets, the report has to show the math.
Or at least the mechanism, yeah. We need to see how this justifies trading at such a substantial premium to its peers.
So the suggestion is to bolster the argument by explicitly showing how these new revenue streams drive metrics like user lifetime value, or LTV, margin expansion, or a significant shift in revenue composition.
That's exactly right. We need to connect the product feature directly to the financial model. Take Cortex. It's a key feature for Gold members. Is the connection between its rollout and implied margin expansion actually established in the report?
Right now, it's just presented as a good new product.
To justify the premium, you need to estimate the impact. If Cortex retains 15% more Gold subscribers, what does that do to average revenue per user? How many basis points does that add to the operating margin?
That level of detail is exactly what transforms a good thesis into an airtight one.
And building on that, what if we included a projection for the required 2026 revenue contribution from prediction markets? To underwrite a $155 target, how much revenue must that new segment generate?
Even just a sentence stating that this target implies prediction market revenue must account for X% of total revenue by Q4 2026.
Driven by Y user penetration, it gives immediate credibility to the target.
I also think just focusing on PE can obscure the real story for a disruptive, high-growth company like this.
It can be very limiting. Especially when you're citing this much innovation, a concrete suggestion is to broaden the valuation metrics beyond just PE. Analyze the valuation in terms of price to sales, or maybe a user growth multiple.
And compare Hood against relevant high-growth software peers, not just traditional financial services companies.
Exactly. When you're citing AI and prediction markets as the core drivers, a PE of 50 warrants a deeper dive into those forward-looking metrics that better capture that potential.
Okay, those are three really significant opportunities for strengthening this analysis. So, to recap for the listener, the core report is timely, it's strong on its technical structure, and it correctly identifies the major growth drivers for Hood.
It's an aggressive and compelling core document, no question.